Assalamualaikum dan salam sejahtera. We meet again in a video. Then this video is to explain on the topic of share buyback, or also known as purchase on shares. First of all, we will look into the statutory requirements. When the company want to purchase their own shares according to Companies Act 2016, sections 127, subsections 2, it says that the company must follow these terms whenever they want to purchase their own shares. First of all, the company must produce an evidence saying that the company is solvent, meaning that company will not go bankrupt if they purchase their own shares, because purchasing their own shares need funding, need money. So the company must show that the company will not go bankrupt when they want to purchase their own shares. The purchase must be made, the second term saying that the purchase must be made through the stock exchange. For example, in Malaysia, need to buy the shares from the open market in Bursa Malaysia, and whereby the shares is being quoted, and must according to the relevant rules of the stock exchange, where whatever Bursa Malaysia or has the rules on how to purchase their own shares, so they must follow that particular rules. And the third term that they must follow is the purchase must be made in good faith and the interest of the company, for the sake of the company only. And the maximum, they will give you 10% from total of share to repurchase the shares at a time. And these subsections 2b, however, the company will be allowed to purchase their own shares in order to cancel or retire the purchased shares, or to retain as treasury shares, or partly retain as treasury shares, and the remainder the cancel of the remainder of the shares. So the company can choose either one of this method. In order to understand the purchase on own shares issue is on the capital maintenance doctrine. In company law, it says that a limited company will not be allowed to retain the capital to its members, meaning that you cannot pay to the shareholders, because the capital is for the purpose of company's business events. So the shareholders should not be paid before the creditors are being paid. In case of bankruptcy, usually the creditors will be paid first. Then after all the creditors has been paid, if they have the money left, then they return the asset to the shareholders. So this is the rules of the company law. And if you look into the subsections, the sections 113, subsection 5 of Company Act 2016, it says that the purpose of purchase on share of share buyback, the directors must make a declaration saying that it is necessary to buy their own shares. There is a need to buy the shares, and the share buyback is to be made in good faith or the interest of the company. So when it says good faith and interest, So they should not neglect their creditors' view or their creditors' concern. So that's why it becomes to rationalize the doctrine of capital maintenance. Whatever you take out the um, shares from our books, they need to reimburse uh, uh, the amount of money to the capital. So that's why we call it as capital maintenance. So the rationale of doctrine capital maintenance is, first of all, to protect the interest of creditor. Because creditor will, if creditor um, says that in statement of financial position there are some money has been taken out, taken out to pay out the shareholders, so the creditor assume that uh, they has been neglected. So that's why you need to maintain the capital even though the the shares has been taken out. Now, the second rationale is to ensure any dissipations of the asset must be in lawful terms, so that your statement of financial positions will not show the capital has been reduced when or after the share buyback uh, has been done. So the reason for the company to buy back their shares, first of all, is to increase the value of shares. Because when the supplies reduce in the market, the open market, so there is a possible the value will be increased. Uh, this is according to the rules of demand and supply when you learn in economics. And the second reason is to stabilize the demand and the supplies of shares in the market. So if the demand is less, we should supply less so that the price is stable. And the third one is to enhance the earning per share ratio. The earnings means that the profit that the company made will be divided into the number of shares the company is traded. So if less number of shares, so the earning per share ratio would be increased. And the fourth one is the uh, possible to eliminate any threat by shareholders who are looking for a controlling stake, because the shares the share is abundance in the market. The shareholders would like to control the company, probably buy all the shares so they could gain a controlling stake in the company. This is dangerous if the shareholders um, uh, are the competitor of your company. And the fifth one is to increase the fund in the future, especially when they use the treasury method, where the treasury shares is bought at a low price and then the company sell them in the future at a higher price. Okay, we look first the share retirement method. Remember, just priorly, I has been said that there are two methods, that is retire or cancelling the shares, or the second method is a treasury method where you kept the shares. Okay, let's look into the share retirement method, where the market price is equal to the carrying value. Okay, let's say you have this example from this Berhad. you have 20 million ordinary shares, 20 million unit ordinary shares, that value of 40,000. And on the 1st November 2018, the company repurchased 1 million units of the ordinary shares from the open market, and the price is 2 ringgit. And the repurchase shares should be for immediate cancellations. So we will calculate the total money to purchase the shares is 1 million units multiplied with 2 ringgit. So the money that you need to have is 2 million. And then the number of ordinary shares will be deducted 1 million unit. So 20 million deduct 1 million unit. So your number of ordinary shares will be reduced to 19 million units. And the value of ordinary share on the 31st December 2017 is, the value is 40 million. And the repurchase value is 2 million. However, you need to add up the 2 million from retained profit in order for you to maintain the capital. So the journal entries share retirement method, where the market price is the same as the carrying value price. Just now we calculate the total money to purchase is 2 million. So you will debit ordinary share capital 2 million ringgit, and you open up a new account as we call purchase own share, whereby we will credit the purchase on share with 1 million. Okay, this particular calculations is actually look into your carrying value. Means that the 2 ringgit is actually 40 million divided with 20 million of units. 40 million ringgit in value divided with 20 million in units. So you have 2 ringgit price per share for the carrying value. And later on, you will debit the purchase own share account and credit the bank account. This is to pay the repurchase shares. And the third transactions that you need to record is to maintain the capital, whereby you will debit retained profit 2 million and credited the ordinary share capital. Your records in statement of financial positions, when the carrying value price is the same as market value price, so you will reduce the bank account by 2 million. So now the bank will have 31,100,000, and number of unit of shares has been reduced to 19 million. However, the value of ordinary share is still maintained at 40 million. However, the retained profit is being reduced by 2 million to become as 21 million and 750,000 ringgit. Now, let's look when the market price is more than carrying value. We use the same example. Now, the market value, market price is at 2 ringgit and 30. And again, the repurchase is for retirement method. Okay, the carrying value price, as we can see in the statement of financial positions, the value of ordinary shares is 40 million ringgit, and the number of units of ordinary share is 20 million units. So your carrying value price of ordinary share is RM2. However, the market value price, as it says, RM2.30. So there is a difference of 30 cents of carrying value versus the market value price. But and the total money to purchase the shares is 1 million units, because we purchase 1 million units, and multiply with the market value price is RM2.30. So you need to pay out RM2.30, 2.3 million ringgit to the shareholders. So number of unit ordinary share capital, still you need to deduct 1 million units, so become 19 million. And the value of ordinary share capital must be maintained at 40 million. Now the journal entries for retirement method, whereby the market price is more than carrying value. So total to retire is 2 million, but total money to purchase is 2,300,000, and there is a different 300,000 that is must set off against the retained profit. So your journal entries first is when you bought or taking out the shares from your statement of financial positions. So you debited ordinary share capital 2 million and purchase own share 2 million, because we bought taking out at the carrying value. However, we pay out the money to the shareholders. We debit purchase own share, credit bank account with the value of 2,300,000. That is the actual money that you pay out to the shareholders. And then you need to adjust your purchase own share account, because there is an additional cost to purchase that particular shares. So you need to debit retained profit and credit purchase own share with the amount of 300,000. That is the difference between the market price with the carrying value price. And the maintenance capitals must be done, whereby you debited retained profit of 2 million and credit the ordinary share capital with the amount 2 million. And the capital maintenance must be done as per the carrying value price, not as market price. So the statement of financial position records when market price is more than the carrying value price. So again, your bank account will be reduced when the money is paid out. So your bank account now reduced to 30,800,000, and the number of units of ordinary shares has been reduced to 19 million, and value of ordinary share capital is still maintained at 40 million. And the retained profit originally it has 23,750,000. Then you need to deduct 2 million ringgit for capital maintenance and deduct again with 300,000. That is the difference between the market price and carrying value price of ordinary shares. So in the end, your retained profit is reduced to 21,450,000. And if the market price is less than carrying value, so your share retirement method will have different records. Okay, let's say the company purchased 1 million units at the open market price, 1 ringgit and 50 cents. And the purchase is for cancellations. So your carrying value price, 40 million ringgit divided with 20 million units. So your carrying value price of ordinary share is 2 ringgit. However, your market value price is 1 ringgit and 50 cents. So there is a difference, 50 cents, between the carrying value and market value price. So your total money to purchase all the shares is 1,500,000, where you multiply 1 million unit with the market value price, that is 1 ringgit and 50 cents. And the number of ordinary share capital should be reduced to 90 million because the 1 million will cancel off, or it says retire, and the value of ordinary share capital should be maintained at 40 million. So your journal entries for share retirement method, when the market price is less than carrying value, so your total to retire according to your statement of financial positions, so your records will be debiting the ordinary share capital at the amount of 2 million and credit purchase own share accounts 2 million, and then you pay out the shareholders debiting the purchase own share 1,500,000 because that is the market value price that you pay, and then credited the bank account 1,500,000. However, there is an adjustment because there is a difference between the market price and the carrying value price. That is a 50 cents difference. So you multiply with 1 million unit that you purchase. So you have 500,000 in excess from the purchase of shares. So you will credit the retained profit and debited the purchase of share. It seems that showing you have an advantage or a profit when you purchase your own shares. Okay, the journal entries for my capital maintenance is still the same, whereby you will debit retained profit of 2 million and credited the ordinary share capital. So your statement of financial position later on, the bank account will be deducted with 1,500,000 to become 31,600,000, and number of unit of ordinary share is being reduced to 19 million because we retire 1 million unit, and the value of ordinary shares still at 40 million, and the retained profit, originally the retained profit is 23,750,000, but then you need to deduct with 2 million for capital maintenance and add up with the adjustment, the difference between the market price and carrying value price, that is 500,000. So your retained profit will be at 22,250,000. Now we look into the treasury method. Treasury method means that as if the company will have the shares as stock. So the Company Act 2016, Section 127, subsection 7, allows the company to use the treasury share to be first distributed to ordinary shareholders as dividend payment. So you do not need to issue bonus share. Just use the treasury share that you held. Or the second one, the treasury share may be to resell in Bursa Malaysia or the stock exchange. However, the company must follow any rules imposed by the Bursa Malaysia. Or the third one, the treasury share can be used to compensate the employees. For example, they can use treasury share giving up to the employees as employees' bonus. Or the fourth one, any method that instructed by the ministry, whether to sell or transfer, or anything that the ministry requires the company to be used, the treasury shares. Or later on, the treasury shares can be cancelled off. If you look at the treasury shares account actually has a debit balance, but please do not assume it's an asset, because the treasury shares account should be considered as a set of account to company's equity. Okay, let's look at an example of treasury share method. The same example from just now, but however, at this time, the ordinary shares will become the ordinary shares that company repurchase will become as treasury shares, and the price in the open market is RM2.50. So the total money to purchase is 1 million unit multiplied with RM2.50, the open market price. So you need to pay out 2,500,000, and you need to create the account, a new account that we call treasury shares. So your journal entries and record for treasury method. So first you pay out, crediting the bank account 2,500,000 and debiting the treasury shares account. And the bank will be reduced to 30 million. Will be reduced to 30,600,000 because you have paid out 2,500,000 for repurchase the shares. So your statement of financial positions, okay, the bank account has been reduced. The ordinary share is remained, meaning that the amount of units of ordinary shares still at 20 million and the value still maintained at 40 million ringgit. However, normally the company will put up notes to this ordinary shares account saying that 1 million unit has been taken out as treasury shares. However, we need to add up the additional information in your statement of financial positions. The total equity should be less with 1 million unit of treasury shares with the amount of 2,500,000 in order for you to calculate the total equity for that particular year. Later on, this treasury share can be resold. Now we look at examples later on, the reselling of treasury shares, and not also known as, if you read the books, they will not say reselling but reissue the shares to the open market. Normally the company will done the reselling or reissue the shares when the share price is actually encouraging, means that the share is good to be resold in the open market. If there is a difference between the carrying value of treasury shares and reissue price or the market price, the adjustment to the equity must be made. So let's look at the example, reselling the treasury shares when the market price is more than the carrying value. Okay, let's look at the example. The 1 million units of treasury shares, and the carrying value of treasury shares, as you can see in statement of financial positions, is 2,500,000. And on 1st September 2019, the company decided to resell the treasury shares in the open market, and the price in the open market is 3 ringgit. So you can calculate the carrying value of treasury shares, 2,500,000, and the reissue price is 3 ringgit per unit. So you can look into the unit of resale, 1 million unit, and the value reissue is 3 million ringgit. So there is a difference of 500,000. The value of reissue at the open market price and the carrying value that has been stated in the statement of financial positions is 2,500,000. So your journal entries and records for reissue the treasury shares when the market price is more than the carrying value price. So you have the value of reissue is 3 billion, but then you have a difference of 500,000, whereby this difference of 500,000 should be added up to the ordinary share capital. So your journal entries debiting the bank account of 3 million ringgit, okay, because that is the value of the issue, 1 million multiplied with 3 ringgit, the open market price, and we will credit the treasury shares with the carrying value of the treasury shares is 2,500,000. So your adjustment to ordinary share capital will be credited 500,000. In your statement of financial positions later on, you will see that the bank account has been increased with 3 billion, so it becomes 33,600,000, and the ordinary share capital value has been increased to 14,500,000, and the treasury shares has been taken out. What happened to reselling the treasury share when the price is less than the market price is less than the carrying value? Okay, let's have an example. The company decided to resell the treasury shares. That is 1 million of treasury shares at the open market of 2 ringgit per share. So you calculate the carrying value of treasury shares is 2,500,000, and the reissue price is 2 ringgit. So the value of reissue, 1 million unit you resell, multiplied with 2 ringgit, the open market price. So your value of the issue is 2 million. So you have a difference of 500,000. But this time, the reissue price is less than the carrying. So your journal entries and records when your reissue value is less than is more than the market price. So your reissue value is 2 million ringgit, but that is a difference of 500,000. So the 500,000 is sort of a loss to the company. So you need to set off this 500,000 against the retained profit. So your journal entries would be bank account debited with 2 million ringgit. That is the money that we receive from reissue the treasury shares. And you need to debit the retained profit 500,000 because the carrying value is more than the open market price when we resell the treasury shares. Then you need to credit the treasury shares at the carrying value of 2,500,000. So your statement of financial positions at the year end. So you see the bank account has been increased by 2 million. It becomes 32,600,000. The retained profit is reduced by 500,000 because of the adjustment, the loss of 500,000. So your retained profit becomes 23,250,000. However, your capital, the ordinary shares, are remained at 20 million unit ordinary shares and the value retained at 40 million ringgit. And treasury shares previously has been written at the bottom of equity. It's no longer there because we have resell the treasury shares at the open market. We sell everything, all the treasury share units. So that's all for now. Thank you for watching the video. See you in the next video.